Welcome everyone to today's presentation. We're going to be talking about swing trading, specifically examples for stocks and ETFs, but you'll be able to apply these techniques to day trading, the futures markets. Everything really transposes pretty nicely across the board. So my name is Tim Racette, and I blog over at eminimind.com. Nice to see some familiar names in the room. And if you do have questions, we are recording the presentation, but if you have questions throughout the session, feel free to use the question box. I'll keep my eye on that throughout the presentation. So a little bit about myself for those that are not familiar with me. I've been trading since about 2006, and I got my start swing trading, and then I made my way to futures for day trading, kind of incorporating that in addition to my swing trading. So now I both swing trade and I day trade, and it's a really nice complement to each other. You know, there's a lot of times where volatility is really high and I may not have as many swing trades, but I have more day trades, and vice versa. Periods where volatility is lower, have a lot of swing trades going on, and maybe I don't have as many day trades. So if you're new to swing trading, or maybe you currently trade Forex intraday or day trade the futures markets, it's a nice addition to have the ability to hold positions overnight without taking on a ton of additional risk like you would if you were holding a futures contract overnight. So like I said, I do both swing and day trade. I've been a presenter at the Traders Expos and the CME group. I'm originally from the Chicagoland area, and I got my start downtown, down at the Board of Trade. And so it's been nice to be able to get out and about at some of the Traders Expos and meet various traders and spend a lot of time in really a great hub of trading, which Chicago is. Outside of trading, I spend a lot of time outside. I like to mountain bike, like to get away from the screen as much as possible and kind of recharge so that I can be very focused during the trading day in the the hours that I am trading in front of the screen or doing homework and things like that. But then also getting away is a really good way to kind of balance the time and the energy needed to trade well with kind of the ability to refresh your mind and come up with new ideas and that sort of thing. So now I live out in Arizona, no longer weathering the Chicago cold winters. I'm an Arizona State Sun Devil, graduated from there, and you can find me over at eminimind.com as well as the usual places, lots of videos on YouTube you can check out, Twitter and Facebook as well. So what I like to do is give you kind of a rundown of what we're going to walk through today, and then we'll go through some examples and kind of tie everything together towards the end. So I want to kind of start with some of the basics of swing trading, talk about my methodology. We'll work out some of the entries and the setups that I use, keeping things very simple. Talk about the stop placements that I use. We'll show you how to calculate position size. You know, if you're day trading, you might be trading, one or two lots on the futures contracts. Well, with if you wanted to risk $100, let's say, on a stock position, getting to that point where each position is that correct amount of risk, and then also looking at the larger portfolio. And if you're putting on 5 positions at once, well, now all of a sudden you have 5 times the risk going on that day. So we'll talk about some strategies to manage that, how I set my profit targets. I'll walk you through the kind of watch list that I set up and use each day. And then we'll just talk a little bit about some tips and things that I've learned from, my 15 years of trading experience and lots of time in front of the screen. So whether you're day trading, swing trading, long-term investing, a lot of the fundamentals are the same. So there's a lot of overlap between day trading principles and swing trading principles. So the first place we'll start is identifying trending stocks or trending markets, because whether you're trading with the trend, or you're trading counter trend, or you're trading range bound, you have to be able to identify whether the stock or the market is in a trend or not. We're going to look at daily charts here for swing trading, and that's a really nice way to be able to slow down the pace of the market. If you're intraday trading, there's a lot happening at a really fast pace. Well, with swing trading, I'm looking at a daily chart. Well, it takes all day for the market to form that candle, and then once it closes at the end of the day, now you can make your do your homework. It can all be done after the market is closed. Really, the only thing you're doing intraday is putting on positions or closing out positions. So I look a lot at the candlestick formations, just a very, very basic candlestick chart. You could use a bar chart, but the idea is keeping things as simple as possible, so I don't have a lot of indicators or lines on my chart. It's really just price and volume. And I'm looking at just very simple, clean patterns in the chart. Very simple things, looking at hammer candlestick patterns, looking at the size of the candle. Like, is the body of the candle really big? Are there long tails sticking out of the candle? Are we in a very sideways consolidation period? Are we moving up in a very tight, neat trend? So all of those things come into play, whether you're day trading or swing trading. But swing trading, the time period gets slowed down a little bit, such that instead of being in the trade, obviously for 5 or 10 minutes, sometimes it's 5 or 10 days. As far as indicators go, I'm really just looking at price and volume, and looking at the chart and looking at those individual stocks or ETFs and relating them to the broader market. So we want to look at, is this particular stock that I'm interested in, is it relatively strong compared to the rest of the stocks and the rest of the market, or is it relatively weak? So looking to buy relative strength and sell relative weakness. That way, if I'm putting on a long position and the stock or ETF that I'm long of is already trending very nicely, but the broader market might just be going sideways, when the whole market gets a lift, then that's going to lift my position even further. Same for stocks that are trending down. If the broader market's trending up, and I find some stocks that are in a strong downtrend, well, if the broader market does turn around and sell off, then that's really going to help accelerate my position to the downside. So looking at that relative strength and weakness is a big part in swing trading. So let's take a look at a couple of charts here. I always like to start on the S&P, and the reason being that the bigger picture is a helpful starting point to get a frame of what's happening in the broader context of the market. So if the S&P is in a pretty decent uptrend and then starts to move sideways and then pull back, then if I flip over to an individual stock, that I'm interested in. And over the same time period, that stock is in a little bit of an uptrend, and then it continues such that the most recent trend of the stock is up, but the most recent trend of the S&P, the broader market, is down. That tells me that this individual stock has relative strength. And when I look at things like volume on the up days, that gives me a strong indication that, okay, there's very strong buying occurring at the same time the market is going up. And on these little pullback days, the volume is much lower. That is another kind of checkbox that gives a lot of bullishness to the individual stock. And that's helpful because when you're sifting through a couple hundred stocks, you really want to get down to a dozen or less that you're going to be looking to trade. And so by picking out the strongest ones relative to the market and the weakest ones relative to the market, it helps to kind of thin out the opportunities and give you just the best opportunities, the best reward to risk that can be presented. So if we do that same scenario for a downtrending stock, back to the S&P to start, or the SPY, so we can get a sense of the volume. Most recent trend in the example is down, and then as we look at an individual stock, the stock earlier trend really down, and then the most recent trend very down, and increasing volume on the way down. That leads to a very, very relatively weak stock and a good one to look to short on a bounce. So as far as the entries go, there's really two ways that I go about putting on positions. So the first one we'll call the breakout entry. And essentially what you're doing is looking for areas of support, maybe areas that you can draw a rectangle or some horizontal lines around where the market's moving sideways. Maybe we've knocked our head on a high for a couple of days in a row or multiple times where we sort of hit a price level, pull back, hit that same price level, pull back. And then once price moves above that level, that's where the entry comes into play. Once we're done consolidating and we move above the consolidation level, that's where using a buy stop, just some sort of way to get into that market. Once it breaks highs, breaks out of that consolidation, that becomes the entry. As for the pullback entry, again, identifying a strong trend, but rather than buying on the breakout, waiting for the market to pull back. And since we've already identified that specific stock is in a strong uptrend, where the assumption is that the trend is going to continue. So looking for the market to pull back a little bit. Maybe folks aren't looking at that stock quite as heavily because it's not necessarily making a new high, but it's close to it. And then we can get in on the pullback and already be in when it makes that new high. So both are strategies that I use all the time, and they both have their place. Both are very useful for swing trading, and you can employ them as well intraday trading. So for the breakout entry, for a long trade, essentially what you're doing is just using a buy stop above the consolidation. And a lot of times it's really helpful to draw a rectangle or some sort of horizontal line or make a reference of, okay, the high here is $100. And every time we come up and hit this $100 price level, that's where we're knocking our head. And so putting a buy stop just above by a few cents, 110 cents for the entry is what I would do in a situation like that. For shorts, it'd just be the opposite. You're looking to short below the consolidation level and putting your sell stop just a few cents below lows. If the stock is $30, I might use 5 cents. If the stock is $100 or $150, I might use 10 or 15 cents. So you can just adjust that, give it a little bit more wiggle room for a bigger price. And then for the pullback, essentially what's happening is I'm looking for if the stock is in an uptrend, looking to buy above the high price of the bar that has pulled back the most. So in this example, we have a little 3-candle pullback where each candle's high is not breaking the prior day, but each candle's low is. It's making a new low without making a new high. So we got a 3-day pullback, and then all of a sudden, the next candle moves above the high, and that becomes the entry, just a few cents above the high price. So buying above the high of the low bar or selling below the low of the high bar for a short. Now, it's helpful to look at relative strength and weakness and buying strong stocks on pullbacks, selling weak stocks on rallies. It doesn't mean that you can't take a counter trend trade and short a stock that's up at highs or buy a stock that's down at lows. You just want to make sure that the context, if you're getting if you're looking for the stock to make a big bounce for some reason, you can use the same entry criteria. You just want to make sure that you're not consistently trying to trade a trend in the up direction if the stock has been trading down for the last 6 months. So, like I said earlier, a hammer formation means something totally different if it's in a pullback in an uptrend versus a kind of in the middle of a downtrend. Or a gap up at highs means something a little different versus a gap up down at lows. So some of the kind of the mechanics of the entries and stop placements. For the initial stop, I'll just use, again, anywhere from 10, 20, if it's a big stock, $200, $300, maybe I'll use 50 cents, and I'm using that as wiggle room. So I'm putting a stop above or below a swing high. So like if I was to get long above a consolidation level, I'm putting my stop below the consolidation level and then adding on 10, 20 cents to give a little bit of wiggle room. So the stop is not 10 or 20 cents away from my entry. It's just below for a long the consolidation level or the swing low or the prior dip, however you want to phrase it. And then for longs, below the swing low, and then for shorts above the swing high. So you can just turn the chart upside down. So if I can first identify the trend, and then I can identify a consolidation level, and I can say I want to be long above highs at the consolidation, but I want to be put my stop in below the consolidation if it fails. That gives me a different stop size for every position. And we'll talk about how I calculate the number of shares here in a minute. As far as, okay, you get in the trade, you put your stop below lows if you're long, and then what do you do once the trade starts to go your way? It's easy if the trade doesn't and just kind of falls down and stops you out. What happens if the trade starts to go in your favor? Couple things you can do, and because presumably you're going to have more than one share, you can actually use multiple exit points. And you can, again, do this for day trading, swing trading, anything that you have multiple contracts or multiple shares of. You don't have to just put one stop. If you have 60 shares, you could divide it up into 20, 20, 20 and have separate exit points. So the places that I tighten my stop to are under the consolidation level, like I just mentioned at the onset of the trade. Maybe the market moves up and then consolidates again, and that's where you can tighten your stop to. You can also get really aggressive and put it underneath the prior candle's bar. So let's say we get long here on the move above this consolidation level. Well, once the candle closes, I can take my stop and move it underneath that candle's low with the expectation that, okay, the market's going to either move higher from here, or if it moves lower, then the trend is changing. So I want to be out. And then the next candle moves higher, and once that day closes, then you can move the stop from underneath the prior candle up underneath the present candle's low. And you can just keep doing that until you get taken out. Now, that's a little bit more aggressive. A lot of times that'll keep me in a trade for 3, 4, 5 days, get a quick run up, and then lock in profit, and you get a little bit of a pullback. The third way that I'll trail my stop is to trail the swing low on a long. So letting the market pull back a little bit and then come up and make a new high and then tighten my stop so that we form another swing low. And so by having 2 or 3 stop placements, you could even put a target out there, which we'll talk about in a little bit. You could put a target if you're risking $2. You could put a target out there at $4 on a small portion of the shares so that you can ensure that you're locking a little bit of profit in right away. Then you can aggressively trail your stop on a portion, and you can conservatively trail your stop on a portion. That way, if the trade does go a little ways and turn around, you've locked in a profit, you've taken off some shares, you have some wiggle room to work with. And then if it continues on, you're still in the trade. And all of a sudden, even if it's a third or a quarter or half of your position that's left, you can sometimes be in these trades for even a couple of months at a time. Market just rallying, pulls back, forms a new swing low, rallies again, pulls back, and then makes a new high, forming that new swing low, and you can just keep riding it out. And that way you're not putting on a trade, taking on full risk, and then having to manage the trade, closing it out, putting on a new trade, assuming the full risk, and then closing it out. You're kind of in and out really quickly. This way slows things down. You don't place as many trades, but you kind of focus on the quality versus the quantity. So let's look at an example of how to calculate the number of shares. I know this is familiar to some of you, but for those that maybe you just buy 100 shares every single time, well, if the stock is $20, you're going to be able to buy a lot more, or buying the same number of shares might be a completely different risk than a stock that's trading at $50. And so it all starts from how much do I want to risk, and looking at the entry versus your stop. So if you wanted to risk $500, that's going to give you a very different number of shares than if you wanted to risk $100. So let's just say you've got a $50,000 account and you want to risk 1%, so $500. The first thing that you need to determine is, okay, where do I want to enter? So I've got a stock, want to get long if it moves above $50, and if it goes below 48, let's just pretend that that's this this consolidation area here. The top line is 50, the bottom line is 48. I want to be long if it goes above 50, but then if it comes back down and rolls over, I want to get out below lows. So that gives us a $2 risk, or a $2 difference between the entry and the stop. So simply taking that $2 into the 500 gives you 250 shares. And so that way, you can keep your risk the same, $500 on every single trade. If you had a trade that was an entry of $50, but your stop was way down at $45, now you've got a $5 difference between your entry and your stop. And then you'd only buy 100 shares, but you'd still have the same dollar risk. And that's the important part. We want to look at the dollar amount that we're risking, not just buying 100 shares every single time. That way we can manage a group of trades much more consistently than having one trade, you've got a $500 risk, and then another trade you only have $100 risk. It becomes very difficult to manage a portfolio with varying risk amounts, especially when you're looking at, okay, if I want to risk 1% per trade, how does that affect the portfolio as a whole? So for example, if I didn't have any trades on and I was going to put on, there was 5 really good setups, and I put them all on in one day, and I risk $500 on each of them. Well, now I'm risking $2,500 at once. All of those trades go on at once, so none of them hit a first target or had the opportunity to tighten a stop. If I put them all on the same day, my total risk is $2,500. So you want to look at, okay, how many trades, if I risk X amount per trade, how many trades am I comfortable putting on? Because if they all go against me, now I could have a $2,500 drawdown if I had 5 trades at $500. As you start to put on trades, some start to tighten their stop, some get momentum, some stop you out. Now all of a sudden you're a couple weeks in, let's say you've got 5 trades on, and one of them hasn't really moved much, so you still have that initial stop. 3 of them are moving in your direction. You've had the opportunity to maybe take a first target or at least tighten your stop a bit, and then the 5th one turned around and stopped you out already. Well, now your risk, like your total risk for those 5 trades, looks a lot different. You've only got 4 trades on. One of them has a full stop out because you haven't tightened your stop at all. It's where it was initially. But then the other 3, if you've tightened your stop, now the risk on those has been reduced. So now your total risk looks a lot different. So it's helpful to be able to focus on the portfolio as a whole, essentially being your own kind of hedge fund manager, whether you've got a $20,000 account or a $200,000 account. You need to be able to look at things in terms of percentages and total risk, because there could be a few days in there that all your positions go down. And so if you have a mix of long positions and short positions, if your long positions, maybe you're in positive territory, but if those long positions pull back one day, then at least you have some short positions that can be gaining ground. And so the long positions might just be giving back a little profit, but it's still down on the day, whereas then the short positions are gaining ground and it can help offset some of those daily losses. And so taking into account the portfolio as a whole is a really big piece in sort of being able to manage your individual trades. So when it comes to trailing your stop or using any variation of moving your stop if the trade's going in your favor. We talked a little bit about this already, but using a trail stop that's based off of the chart, I like better than in just an arbitrary, okay, I'm going to trail by $2 and I'm just going to use a trailing $2 stop. So when you use things like the prior day's low, you have a very structured stop level, but it's also based on the price action that's occurring on the chart. When you're using a prior swing low, you're using the price action from a recent consolidation. A major support level, same thing. It's a level that's been tested and support has been achieved there, such that if it breaks that level, now we have a change or a failure in the trend. And then the same thing is just reversed for shorts, above the prior day's high, above the prior swing high, above the major resistance or consolidation level. And so one thing to consider, if the market's really strong broadly, and you got 6 positions on, maybe you have 5 longs and 1 short. If the market is moving sideways, maybe then you only have 3 and 3 longs, 3 shorts. If the market's moving down, but not super strongly down, maybe you have 4 shorts and 2 longs. So it's always nice to have, at least 1 or 2 positions on in the opposite direction of the broader market. That way, when the broader market does pull back, like I was saying, you get to cover some of those daily losses with a stock that's making gains to the downside. It's also important to look at your portfolio as a whole and say, okay, what positions are doing well and what positions are not, what's working and what's not working. That's a great exercise just to do on a daily and weekly basis, asking yourself what's working and what's not working, so you can really focus on what's working and stop doing the things that aren't working. And when you do this, let's say you have a limited account of $50,000. Well, by the time you put on 5, 6, 7 positions, you very well might be at your max capital capacity, because when you are trading the underlying stock or ETF, it takes a little bit more capital to manage a position, especially when you're talking 100, 200, 300 shares. If the stock's trading at $200, $300, your risk might be the same as a stock that's only trading at $20, but it's going to take a lot more capital to control that position. So if you do get into a situation where here's 3 new good trading opportunities, but I've already got a full portfolio of 6 positions, look at the one that's lagging and cut that one. What you don't want to do is look at the ones that are doing well and cut those, because then you're just sort of capping your gains, and you're not able to, if you're not able to let those winners run, then you'll just be capping your gains and then hanging on to your losers, and then the losers just kind of churn and eventually might stop you out. And if there was a better opportunity out there, then you're missing out. The opportunity cost is not that great. So when it comes to putting together a watch list, there's a couple little things that I set my scans for. There's a website called FinViz you can use. It's pretty simple and free. Most of the trading platforms have built-in watch lists. So wherever you do your watch list, the idea is to just run the search each night to get a list of stocks that are, as you can see with the highlight there, making new highs is the first thing I search for, as well as stocks that are making new lows. So I got 2 searches. I want to know which stocks are making new highs and which stocks are making new lows. I want them to be over $15 $20 is even better, but that way, I'm not getting into the penny stocks or stocks that are just artificially inflated for whatever reason. And then I also look at the other scan is for Fox that, or a stock, excuse me, that don't, or that have more than 200,000 shares of volume traded on average. That way, again, you don't get into a position where you can't put on a position because there's not enough trading volume. Once in a while, you'll run into stocks that you're not able to short. You run into more issues with stocks that may not have options on them. So regardless if you're trading an option versus the underlying, there's going to be some positions that you just can't get a hold of. But for the most part, if you're trading bigger name stocks that have decent volume, then they're going to be easy to short, and you're not really going to have slippage problems. Most people aren't putting on 10,000 share positions, and even at that, some of these bigger stocks can just absorb that very easily. Then essentially all you need to do is just jot down the list of stocks. I just use just an Excel spreadsheet. If you run your scan and you get 10 stocks, another day you might get 100 stocks. I just add them to the list and then just get rid of duplicates. And then once the few days go by, then you can go back to that list, and the stocks that were making a 52-week high, that's how they got added to the list. Now they might have pulled back for a few days, and folks might not be looking at them as closely. So you can just look for those stocks that you already know they're very strong because they were making a 52-week high. You can let them pull back a little bit and then look for that either a pullback entry or a breakout entry. And you're sort of putting on your position before it's reaching the mass market, if you will, especially with the pullback entry. And it's a really good way to establish a list of high quality stocks, long and short, and then with a little bit of patience, getting into those positions and letting the trend continue. One thing that I'll do with the list is just do a quick run through on the weekly chart, just to make sure that things look clean. I don't want maybe it's making a 52-week high, but the overall trend is sideways. I also want to see, okay, it's making a 52-week high. Is it near all-time highs, or is this just a new high for the year? For longs, we talked a little bit about this, but looking for stronger volume on a rally. And then for weak stocks, or for the pullbacks, I want to make sure that there's a little bit weaker volume on the decline. That sort of gives more weight to the bullishness, and then vice versa. Again, for shorts, strong volume on a sell-off, weak volume on a bounce. Other things that I look for are consolidation and triangles, and then just really looking at, is the chart clean? Is there clear support and resistance, or is it just a big jumbled mess? And then a few final things that things that occur on a pretty regular basis. I'm not a fan of trading earnings. There's just too much whipsaw price action that can happen. When you get into a gap situation, the first thing is always to stay calm, and then I always wait the first 15 minutes before I will sort of manage the position in any way, because a lot of times what happens, if you're long and the stock gaps down against you, that first 15 minutes ends up being the low of the day. So I just adjust my stop if I'm long to be below that first 15-minute candle. And there's a lot of times where a stock gaps down, people close out of the position, and then it ends up right back where it was and then continues on. And if you just wait 15 minutes, a lot of times you can stay in those trades. There's two good books that are definitely worth reading. The first one's not super common. It's called How I Made $2 Million in the Stock Market. Kind of a little bit of a silly name, but that one's by Nicholas Darvis. It's really good. And then the Market Wizards books by Jack D. Schwager that I'm sure a lot of you have read are very good. Those are good because they give you such a broad perspective, different traders, different types of markets, and you can start to see a lot of similarities and really understand the thought process that's similar among a lot of these really great traders. And then the last thing is that there's really no shortcuts or substitutes for screen time. You can speed up the learning curve in some cases, but it's really important to work smart, but also be patient and stay disciplined. The market's always going to be there. If the market does disappear, then we've got bigger problems than just being able to trade. So if you can work smart with your time and really be focused and intentional with your time in front of the screen, that's going to really help speed up your learning curve, as opposed to just twiddling your thumbs and jumping from strategy to strategy. Being very focused, and when you find something that resonates with you, a type of trading method, a style, a particular market, maybe you really like options and specifically bull call spreads or something like that, really dive deep into it. Get to understand all the ins and outs, become a master of it, and that will get you a lot further than trying to jump around, following all the talking heads and all of that kind of garbage. It just ends up slowing down the process. So if you do have questions or want to chat about your trading or anything trading or non-trading related, feel free to shoot me an email. It's just tim@emoneymind.com, and you can check out, I've got a whole bunch of really good articles and things that I've written in videos over at emoneymind.com as well, outlining everything from kind of my trading mindset to the specific techniques that I use, and always like sharing and discussing ideas with other traders. So thanks so much for tuning in this morning, and I wish everyone a great rest of your day, and take care.